Steps toward financial freedom. It has been charged for promoting greed, starting wars, and claiming lives. Contrary to popular belief, money has not enslaved people. Rather, if used effectively, it may be your ticket to true freedom, freeing you from the burden of worry about the future. Hey guys, welcome to our channel. In today's video, we are going to talk about the steps toward financial freedom. Let's see what we have for you related to money. If you want to find out more about it, then stay with us until the end of the video. Also, before we start the video, don't forget to hit like, subscribe to our channel, and ring the bell icon for more amazing videos. And let's get started. While people strive to earn as much money as they can during their working lives, they may not always make the best use of it. So many people fail to save enough money to last them through their post-retirement years, despite working their entire lives to accumulate wealth. To be fully free, you must strive for 5 financial freedoms: freedom from need, freedom from uncertainty, freedom from debt, freedom from loss, and freedom from deception. We'll explain how to guarantee your freedom from monetary concerns. We go over every stage, from the moment you start earning money to the moment you hang up your work boots, and show you how to adopt tactics to keep your money secure and growing. To become financially independent, you must first distinguish between needs and wants. Savings, not consumption, should be your top priority as soon as you start earning money. Once you've reached your monthly savings goals, the remaining funds can be spent. Saving at least 20 to 25% of your income is advised. However, some financial experts advise saving up to 40%. Retirement feels far away when your career is just getting started, but it's closer than you might imagine. You should attempt to save more when you're young and don't have commitments like children or an EMI, says certified financial planner Pankaj Mathpal. Make sure you set aside at least 10% of your income for retirement in a variety of places, including PPF, NPS, and diversified equity funds. Naturally, the Provident Fund ought to serve as the cornerstone of your retirement preparation. Even while retirement is the culmination of your efforts, you should still make plans for other long-term objectives. To meet these demands, equities can be the greatest option. An anxiety-free life can be ensured through regular investments, whether through SIPs and funds or recurrent contributions. Individuals ought to use a bucket-style investment approach. Financial consultant Anbhav Gulinsha advises people to invest in fixed income securities and steer clear of stocks for short-term goals that are 2 to 3 years away. Create an asset allocation strategy that includes risky equity and real estate and risk-free fixed deposits, debt mutual funds, PPF, investments for long-term goals, and invest in accordance. It is simple to give in to the urge to skip an SIP or break your FDs in order to use the money to fund a desire. While doing this will make you happy right now, you might eventually regret sacrificing your more significant objectives. Freedom from want. Save enough to ensure that you will never run out of money to achieve your objectives. Your winning strategies should include saving at least 10% of your income for retirement. Begin saving for children's education as soon as they are born. Designate funds for particular financial objectives. Don't use funds for discretionary expenses. Instead, increase savings in proportion to income growth. Even the most well-laid-out financial plan can be destroyed by unforeseen costs. Your retirement plans may be delayed, and there may be less money left over for your children's schooling. They can force you to cancel your upcoming vacation or put off buying a property. By preparing for such crises, you can lessen their effect. Start saving once more on your first day of employment. Make a contingency fund the first thing you invest in. You must place money equivalent to 3 to 6 months' worth of spending in a liquid mutual fund, short-term fixed deposit, or a bank savings account. They are simply withdrawn without incurring fines to cover any unforeseen expenses. Purchase appropriate insurance next. Personal accident insurance should come first, then health insurance. Financial advisor Hashvardhan Rungda advises residents in metropolises to purchase health insurance that costs at least Rs 5 and 10 lakh. Even if you are protected by your employer's group health plan, consider getting one nonetheless. It can be useful if you're between jobs, or worst-case scenario, you lose your job. Personal accident insurance has 2 advantages. In the event of an accident-related death, the dependents of the insured receive the sum assured. Additionally, it compensates the insured should an accident render him or her incapacitated. Only Rs 1,500 will be spent annually on an accidental death and disability policy worth Rs 10 lakh. If you have dependents, purchase life insurance. We're discussing pure protection term plans here, not ULIPs endowed policies. 5 to 6 times your yearly income is a good rule of thumb for adequate life insurance. Consider obligations, and if you can, get a larger cover. A 30-year-old can purchase a term insurance policy online for Rs 1 crore for around Rs 7,000 to 8,000 per year. Freedom of uncertainty. Don't let unanticipated costs and expenses throw your budget off course. Your winning strategies are to purchase life insurance equal to 5 to 6 times your annual income. Maintain a reserve fund to cover expenses for 6 months. Get at least Rs 20 lakh in personal accident and disability insurance. Insure your home and other assets against damage and theft. Purchase family health insurance totaling at least Rs 5 lakh. You run the danger of being put at the bottom of the list if you set overly ambitious return goals. Making uncertain calls is never a good plan. Prioritize your aims over your profits. Kumar Vivek, a native of Navi Mumbai, is a good investor. His portfolio has a third of debt and is skewed towards stocks. He is also debt-free because he had paid off a mortgage loan. He is as financially independent as one may be by adding enough life and health insurance. He has investments in real estate, debt for short-term purposes, and stocks for long-term objectives. Not every asset produces strong results all the time, according to Mathpal. Diversification reduces risk and produces solid long-term returns. You would be adhering to the idea of not placing all your financial eggs in one basket if you had a well-balanced portfolio. Freedom from loss. Don't let fear and greed dictate your investment approach. Your smart moves are: establish an asset allocation and diversified portfolio. At least once every year, rebalance your investment portfolio. Avoid aiming for spectacular profits. Match the asset class's investing horizon. In recent years, Indians have shown a tendency toward irresponsible spending and borrowing. Credit cards were used carelessly and thoughtlessly as tools for squandering money. Following credit card defaults during the previous 5 years, banks that had remained cautious turned active again, promising loans with lightning-fast approvals, notably online. It's simple to overfill your shopping basket with products you may not need in the era of internet shopping and steep discounts. Many people don't hesitate to take out personal loans to improve their vehicles or a vehicle loan to go on vacation. It's advisable to refrain from borrowing to pay for such luxuries, or for that matter, to invest, particularly in stocks. Such choices could be fatal to your capacity to maintain financial stability. Unsecured loans, such as credit cards and personal loans, have high interest rates that range from 15 to 44%. Secured home loans, which also offer tax advantages, are regarded as good loans because they contribute to the creation of an asset. Live within your means while separating needs from wants. It's easier said than done because watching your friend flaunt the newest smartphone, car, or outfit is sure to make you want to go shopping. Make a list of your retirement and desires. Try your hardest to achieve the former and develop the ability to let go of the latter. If you must borrow money, make sure to repay it in time. It will harm your credit history in addition to raising your interest costs and trapping you in a cycle of debt. You will then find it challenging to get loans in the future as a result. Freedom from debt. Don't let careless spending tie you to debt. Your good moves are: no more than 50% of your salary should be spent on EMIs. Do not borrow money for unneeded expenses. Distinguish between your wants and necessities. Ensure prompt and consistent loan payback. Avoid using funds to cover discretionary costs. You would be better off examining any investment option on the basis of your risk tolerance, its regulatory environment, and business strategy, than naively investing in the hot stock or high-return scheme your friend is investing in. The Ponzi scheme and fraudulent offer landscape in India is rife, wiping out the savings of small investors. People invest in dubious schemes and shady businesses with a spotty past because they are greedy for big rewards. You need to examine and manage this fundamental behavioral defect. Additionally, before making an investment, confirm that the scheme is overseen by regulators like the RBI, SEBI, IRDAI, and PFRDA, advises Galucha. Prior to participating, take some time to review the program's booklet. Freedom from fraud. Don't let avarice tempt you into risky investments. Your good moves are: steer clear of investments with high returns. Prior to purchasing an insurance policy, understand its features. Use credit cards and internet transaction security measures. Refrain from accepting false promises of quick money. And this is it for today, guys. What are your thoughts on today's video? Share with us in the comments below. Also, don't forget to hit like, subscribe to our channel, and ring the bell icon so you don't miss any of the latest updates. And thank you for watching.